So we're going to cover Chapter 11, Financial Statement Fraud. And this is an important chapter because it sets the stage for why people commit financial statement fraud. And as we read the number, we're going to go through the history of the market and talk about the various bubbles and financial statements frauds that have occurred over time and basically why they do it. And we're going to culminate with why there were so many frauds in the late 1990s, early 2000s, like Enron, WorldCom, HealthSouth, Tyco, all these companies that have committed financial statement fraud. And the number is really good because it explains the incentives and the pressures that lead people to commit financial statement fraud. So as we go through Chapter 11, we have several learning objectives. First, we want to talk about the role that financial statements play in the capital market. We want to understand the nature of financial statement fraud, become familiar with fraud statistics, how financial statement frauds are concealed. We want to outline the framework for detecting financial statement fraud, identify red flags and relationships that others have with companies that are potentially committing financial statement fraud. And if we analyze those relationships, we can potentially uncover some red flags there as well. And we know that financial statements play a key role in the capital markets because they lead to market efficiencies. The more information, the better information that we can provide to the public, the better the public, investors, regulators, and others can make decisions related to a particular investment or to a particular company. So the better information that's in the market, the better investment decisions that people make. Now, obviously, everybody in the U.S. that files their financial statements with the SEC has to file according to U.S. GAAP. Although recently, international companies, they can file under IFRS, even if they're traded on the New York Stock Exchange. But for the most part, U.S. companies follow U.S. GAAP, and so we have one standard of accounting that everybody follows. And auditors, you have to hire an auditor if you're a publicly traded company to audit your financial statements. And your auditors are key in helping you make sure that you are indeed following GAAP. And by following one set of accounting principles and standards, that allows investors and regulators to analyze companies across industries and across time, because they're all using the same method to account for their transactions. So, unfortunately, though, financial statements are sometimes prepared in ways that intentionally misstate the financial position and performance of an organization. And that's because there's just a lot of pressure on companies out there to report good performance. And occasionally, some managers and others can rationalize misreporting. And we're going to spend a lot of time talking about why companies do that, especially as we read the number and talk about the sort of history of the market and the history of financial reporting. But basically what happens is we know that with financial statements, basically all the financial statements are estimates. So all the accounts in the financial statements are made with estimates. The only real hard number potentially is cash on the balance sheet. But almost every other number on the balance sheet and income statement is made up of some type of estimate. And so all companies have to do to potentially misstate their financial statement is change the assumptions that goes into those estimates. And for example, if the consensus analyst forecast, so if analysts are predicting that a company is going to have their earnings per share, when they report their earnings per share, is going to be $1.12, and the company realizes that, well, the analysts are expecting us to have $1.12 earnings per share, but they know that when they calculate their financial statements, it comes out to be $1.11. Well, they may think to themselves, okay, we need to do $1.12. To get to $1.12, all we have to get to is earnings per share of $1.11.5, and then we can round up to $1.12. And that's so much income they may determine. And so what they'll do is they could potentially look at their estimate related to bad debt, to their allowance for doubtful accounts, and say, well, in the past, we've created an allowance for doubtful accounts that's roughly 10% of our accounts receivable. But maybe that's really more like 9%. Maybe we've been a little bit too conservative over time. So this year we're only going to accrue for 9% of accounts receivable and put that in the allowance for bad debt. And so if they do that, then that reduces their allowance for doubtful accounts. It also reduces their bad debt. And by strategically reducing it just a little bit, maybe that gives them the extra income that they need to round up from $1.11 to $1.12 so that their earnings per share comes in exactly what analysts forecast. And these analysts are people who work for the major brokerages like Goldman Sachs and others, maybe it's Merrill Lynch, could be Bank of America, could be any bank that has analysts that follow a company. And why do these brokerages have analysts that follow the company? Well, they're trying to get people to invest. One way that they make money is when people buy and sell stock through the brokerage. So they want to provide information to their investors and help them make informed trading decisions, so they'll trade. And when they trade, then the brokerage gets commission. And so they have these analysts that are providing information to investors. And so one piece of information that they provide is they follow a company, they follow an industry, and they make estimates related to what they think their earnings per share is going to be. Well, if they miss that earnings per share target, research has shown that their stock price usually goes down. And if they beat it, their stock price goes up. And if management has a lot of equity in the company and a lot of stock options, for example, in the company, then if the company's share price goes down, then management, like the C-suite, the CEO, the CFO, their personal wealth is potentially tied into the financial statements and the numbers that they report. So it puts a lot of pressure on them to keep the stock price from going down by reporting net income or earnings per share that's consistent with what these analysts are expecting. And so they also can easily rationalize that what they're doing by maybe understating bad debt expense just a little bit to get that extra cent of earnings per share to come in what the analysts expect. By doing so, they can tell themselves and rationalize to themselves that they're protecting their investors from the stock price actually going down. So they say, we're a really good company, and all we have to do is just change an estimate here or there, and then we can magically get the net income that we need to get the earnings per share targets that our analysts and investors expect. And if we do that, then the stock price doesn't go down, and everybody wins. All right. The problem is that if you continually change your estimates, then eventually your financial statements are actually misstated. So there's a tremendous amount of pressure on organizations to meet these analysts' expectations for earnings per share. And when companies focus on that short-term meeting earnings per share, that can lead to misstating their financial statements by a lot. And so misleading financial statements can cause serious problems for the market and the economy. Because ultimately, when they have to restate, when the fraud comes to light, then the shareholders lose big. Because the stock market, at that point, the stock price craters on the announcement of fraud, and then usually they have to change management, they have to restructure if they can even stay in business. Like Enron wasn't able to do so. But if they have to restructure and come out of it, and they're usually in much worse shape than they were before they committed fraud. So if they had just disappointed the market a little bit and not started manipulating their earnings number, and to the point where it got to be fraudulent, the company may have disappointed the market just a little bit early on, but that would have been eventually, the company would have, the analysts would have, in the future, would have recalibrated sort of what they expected about the company, and then the company would have been able to meet more realistic earnings targets. And so the stock price may have gone down a little bit, but it wouldn't have led to fraud and had the stock actually crater, and then people lose a lot of money. So financial statement fraud is serious business, and it happens, unfortunately, too often. And what we see, and as we read the number and we talk about this, what we're going to see is that it oftentimes happens when the economy is doing really well, and then the economy starts to turn a little bit. And when that happens, companies want to continue to report well. They want to continue to show that history of increased net income. And when they can't show that anymore, that puts a tremendous amount of pressure on them to show it artificially and commit fraud. So that's why we see, in bubbles, expectations about the company's performance get to be too high. And then when the bubble bursts and the economy starts to go down, that's when you start to realize that a lot of companies have succumbed to that pressure to show increased earnings over time. So like we said, these misleading financial statements, once they're caught, lead to large losses for investors. And not only that, it leads to lack of trust in the market. So then it makes people scared to put their money back in the market because they start thinking, well, maybe the market's rigged. Maybe the information, all information that's reported is inaccurate. And so anything that creates a lack of trust for the market is bad and suppresses stock prices. And ultimately, it also leads to litigation and embarrassment for individuals who are involved. And obviously, litigation doesn't serve anybody's purpose other than paying the lawyers. So misleading financial statement or financial statement fraud is a serious problem. We're talking about financial statement fraud, and the later half of the semester, we're going to talk about embezzlement. And embezzlement is when employees steal from their employer, and that happens a lot, but it's not nearly as serious and creates as much market damage and collateral as financial statement fraud. And if we look at, there's several examples of financial statement fraud. They're sometimes called cooking the books. And Quest, Enron, Global Crossings, WorldCom, Xerox. There's just hundreds of examples of companies that have committed financial statement fraud, as you've probably seen as you've tried to identify a company to work on for FS1. And not only is there cooking the books, there's also companies not only cook the books, sometimes they also loot the company. So John Regas at Adelphia was one of the founders, and he was taking basically $1 million a month out of the company just for personal use. Same with Dennis Kozlowski at Tyco. He had, I think, threw $1 million birthday party for his wife. That was all business expense. He had gold faucets in his apartment in New York. So not only do they commit financial statement fraud, sometimes the executives also loot the company that they're working for. Bernie Evers is doing the same thing at WorldCom. And then somewhat related to financial statement fraud is insider trading. So we have the example of Martha Stewart. Her friend Sam Waxel was CEO of a company called mClone, and he had given her information about an acquisition related to mClone, and Martha Stewart traded on that information before it was publicly available, and the SEC came after her because it's illegal to trade on information that's not publicly available. So once you become aware, even if you're not part of the company, if somebody in the company tells you about information that's private, that's eventually going to affect the stock market once it becomes public, you can't trade on that information. And that's what happened to Martha Stewart. And there's been a lot of cases of insider trading recently. And insider trading is also a bit of a problem because it also destroys people's trust in the market. When they think only the rich and powerful, they're all trading on insider information, and it's only the people who don't have inside information, the schmucks like you and me, are out there trading on other information, and we get ripped off by those that have insider information. So insider trading creates mistrust in the market as well. Now, why do these frauds occur? Well, we've been talking about the fraud triangle. So perceived pressure, perceived opportunity, and rationalization. We're going to talk later on about how the fraud triangle is a really good fit for embezzlement. It's not quite the perfect fit for fraudulent financial reporting, because fraudulent financial reporting requires collusion. And collusion, when multiple people are involved with misreporting these financial statements, not everybody has the same perceived pressure and uses the same rationalizations. But we'll talk about collusion and how people recruit others to commit fraud, financial statement fraud, as we go along. Now, the book says that there's several reasons why the early 2000s, the bursting of the high-tech bubble, and the precipitous drop in the NASDAQ, the book argues that there was these elements that were a perfect storm for this to happen. One was a booming economy. And as we continue to read the number and we talk about it, we're going to find out that during booming economies like the Roaring 20s, when there's new technology, we tend to overvalue things that are new. We create bubbles, and then when the bubble bursts, it creates a tremendous amount of pressure on people to not recognize or want to just ignore that the bubbles burst and continue to report magical earnings. So that happened in the late 1990s. There was a bubble of a booming economy related to high-tech stocks. There's a perception that there was a decay in moral values. That can be argued. The book cites statistics about cheating and other things that appear to have gone up. So it's possible that people became less ethical over time, but I think that's a little bit debatable. I think it was a factor of other things. I think people have always been willing to commit financial statement fraud given the right pressure and opportunity, and all they needed to do was rationalize it. There was a lot of misplaced incentives, and we're going to talk about those incentives, and that primarily relate to management's incentives to misreport, because what was happening, especially in the technology industry, technology companies were giving employees, especially their management team, huge amounts of stock options. And these stock options, well, they originally thought, well, this is great. We give these folks stock options, and then they're going to want to do what's best for the shareholders because they're essentially going to be shareholders in the company. Because in the past, they'd seen too many CEOs who received high salaries that ran their company into the ground, but they still got these huge cash salaries. So it was decided a while back that it's probably better to provide, not huge salaries in terms of cash salaries to management, but to give them stock options in the company. That way, if the stock does well and the shareholders profit from that, then management will also profit from that through their options and their equity in the company. The problem, though, was when the management's personal wealth was tied into the share price of the company, and the share price is almost directly related to financial performance. It gave tremendous incentive to management to misreport the numbers if reporting accurately was going to cause their stock price and their personal wealth to go down. So giving significant amount of options and equity incentives in the company created a little bit of a misplaced incentive for companies, for management to misreport once the booming economy sort of subsided. And we talked about high analyst expectations. Obviously when the economy is booming, then management expects that boom to continue, and their expectation of company performance gets a little bit too high, a little bit too unrealistic. And now companies are trying to meet unrealistic expectations, and that resorts to fraud. Companies were also using a lot of debt. Alan Greenspan had kept interest rates low for a long period of time, and low interest rates led people to take out a lot of debt. And when you have a lot of debt and you have to make debt payments, that always creates a lot of pressure on you to misreport. When you have debt payments you have to make, you have to show good results so that you continue to get investors and share and debt and potential banks and others who want to loan you more money. To get access to that money, you have to show good performance. And there was a focus on accounting rules rather than accounting principles. And this is where things get really tricky, because the SEC would like the FASB to write accounting standards, GAAP. They would like to write the accounting standards to be really specific so that they can enforce a rule. So like in the case of capital leases, there's like specific rules that the future minimum, the present value of the lease payments, if they're 90% of the fair market value of the asset, then you report it as a capital lease. You guys probably remember the rules for capital lease. Or if the useful life is 75, if the lease term is 75% of the useful life of the asset, then you report it as a capital lease. Or if there's a bargain purchase option, or if it just reverts to the lessee at the end of the lease, those are all reasons why you would give capital lease treatment to an asset and record it as an acquisition versus a lease. Well, those are specific rules, and the SEC likes specific rules like that, like 75%, 90%, because they can enforce those rules. The problem, though, is if you give these specific rules rather than principles, then companies can focus on meeting exactly the rule while violating the principle. And that's a lot of the standards are written as rule-based standards rather than just providing a principle. So in the case of capital leases versus operating leases, the standard setters could have not used 90% or 75% and just give general guidelines on when you report something as a capital lease versus when you report as an operating lease. And if they'd given general guidelines and said you have to do the right thing based on these guidelines, then they could have worked with their auditors and others to try and meet the underlying principle. But once you've given them hard and fast rules that say 90, 75%, then they say, okay, I want to report. They may have a preference for reporting something as a capital lease because they don't want to put the debt on the books. Report something as an operating lease versus a capital lease because they don't want to put the debt on the books that they would have to under a capital lease. So then they structure the lease agreement to be 74% of the useful life and 89% of, the present value is 89% of the lease payments. And then they say, well, tell their auditor, see, we're just below the threshold, so therefore we have an operating lease versus a capital lease. When maybe their intention all along was to actually purchase that equipment, but to get the treatment that they want and to keep the debt off the books, they just barely get under the rules. And so then they can tell their auditor, see, I'm under the rule, I'm under this threshold, so you have to allow me this accounting treatment. And when we focus on rules versus principles, that's when we can get ourselves in trouble. And in fact, that's what happened at Enron. The managing partner of Anderson, after Enron went under, basically blamed the rules, said we're too focused on rules versus principles, and that's a problem. And he tried to blame that as a reason for Enron, that Enron technically tried to follow all the letter of the law while violating the principle of the law. So that's a big issue. So it's a lack of auditor independence. I mean, another good example of that was Enron. So Enron was audited out of the Houston office of Anderson, and Enron was paying Anderson about $1 million a week, and that wasn't all for the audit. They were doing a lot of consulting for Enron. And when so maybe the audit was $10 million and the consulting fees were $40 million. But when you're doing a significant amount of consulting work, it puts a lot of pressure on the audit partner to go along with the accounting treatment that the client wants. Because one thing that Enron could easily do is tell the audit partner, who was at the time David Duncan, they could say, look, Duncan, we don't really like what you're telling us about our accounting. And, maybe it's time to find another auditor. And that $40 million in consulting fees, Ernst & Young would like to have that too. So as a new audit partner, like David Duncan was at Anderson, you don't want to be the one who lost a $50 million revenue stream for your office. So it puts a tremendous amount of pressure on audit partners to go along with the accounting that their client wants versus what's right. And that appears to be what was happening at Anderson. Now, and that got a lot of press coverage, and Sarbanes-Oxley changed the rules that you can't do consulting if you also do the audit. There's other things you can do, like tax work, like preparing tax returns for a client, but you can't do consulting if you also do the audit. So they changed the rules. And it's not clear from the research and others that audit partners' independence was actually impaired, but it did look bad. I mean, you could make the argument that why would the audit partner risk his whole livelihood to benefit the consulting partners? Because if things go bad with the audit, it's David Duncan who loses his license and potentially goes to jail, not the consulting partners. So it's not, the line isn't clear that these consulting fees were actually leading auditors to jeopardize their independence, but it did look bad. And in the case of Enron, when you're looking back and saw that they're paying $50 million to a year to Anderson, it does look like, well, maybe their independence was impaired. And then the other argument is that greed. I mean, it's hard to say greed was any worse in the 90s than it was, the 20s or any other time. But it is mentioned as one of the elements of this perfect storm. And then the textbook, the writers, they argue that educators failed. That, when we're educating folks at giving them their MBAs, at Harvard and some of these Ivy League schools that put out a lot of CEOs, that they weren't doing enough to talk about moral values and ethics. And people were focused solely on making money and meeting the rules and not worrying about violating the principles. So there's a perception that all these factors sort of came to a head during the late 1990s, early 2000s that led to this wave of financial statement fraud that we saw in the early 2000s. Now, the nature of financial statement fraud, it involves intentional deceit. Right? Now, management is not going to say that they intentionally meant to deceive the public. But when the fraud gets as egregious as it is, like in the case of WorldCom and Enron, it's hard to argue that management didn't know that they were intentionally putting out financial statements that were false. The problem that would happen, though, was, like in the case of WorldCom, Bernie Ebbers would say, well, I'm a poor high school wrestling coach, because that's what he did before, in his early life. he would say, I don't really understand financial numbers, and I relied on my CFO to do that because their defense basically was it's not illegal to be stupid. It's illegal to intentionally deceive the public and put out false financial statements. So they would try to claim that they didn't really understand financial statements, and they relied on the controller and the CFO to put those out. But the court, especially in the early 2000s, with all those frauds with Enron, WorldCom, Tyco, with like the Kenneth Lays, the Jeff Skillings, the Bernie Ebbers, the Richard Scrushies, the Dennis Kozlowskis, they were able to get convictions in those cases because they were able to prove that they actually intended to deceive the public, that they did indeed understand the financial statements, and that those financial statements were indeed misleading, and they knew that they were misleading when they put them out. That's why when the Sarbanes-Oxley law came out, one of the provisions in there was that the CEO and the CFO have to sign a statement now saying that they not only have they read the financial statements, that they understand the financial statements and that they think the financial statements are free of fraud. That way, in the future, when they go to charge people with fraud, and they try to say, the CEO tries to say, well, I didn't really know, I don't really understand financial data and financial information. I rely on the controller. They can just pull out the certification from the 10K and say, well, it doesn't matter what what you're saying now. At the time you filed these financial statements, you said you understood them and they were free of material misstatements. So you're either lying then or you're lying now. So that was part of Sarbanes-Oxley. Part of the plan with that law was to make convictions easier, so that it would be easier to prove deceit, because they could say they'd have to sign a statement saying that they do not think these financial statements are misleading, and they can't plead ignorance. Now, financial statement fraud is rarely seen in the sense that we don't see people actually making the bad journal entries. And the problem with detecting financial statement fraud is it's just like any rare event, is there's a lot of false red flags. So there's no one indicator that says, if you see this, it's likely to be fraud. Because no matter what the red flag is, it's likely that any given company is not committing fraud. So it leads to a lot of false positive or a lot of false red flags. That's one of the reasons why it's so hard to detect. There's no one silver bullet to detecting fraud. And like we talked about, conviction is very difficult because you have to prove in a court of law that the company intended, or management, individuals intended to deceive the public. And sometimes that's difficult without having an email or a wiretap or something where they're actually saying, yeah, I'm intending to deceive the public. It's hard to prove that that was their intent all along. But given the success of the convictions in the early 2000s, like I said, with the Dennis Kozlowskis and the Richard Scrushies and the Kenneth Lays and Jeff Skillings, they were able to get convictions. But I remember during the Enron trial, when I was teaching this class, I was telling the students back then, this is going to be harder than you think to convict these guys, because you're going to have to prove that they intentionally meant to deceive investors. But when we read the Fool's Gold, we're going to read that banks did a lot of shady things, and there weren't a lot of convictions in 2008 when the market crashed due to the real estate bubble, because it was hard to prove that indeed companies were taking on too much debt and taking on too much risk that led to a lot of bankruptcies and a lot of bad business decisions. But it's very difficult to prove that they actually intended to run their company into the ground or deceive investors. So there's fraud statistics to kind of give us a sense of, okay, who's committing fraud, how big is it, what are the common accounts that are doing it? Because between 1997 and 1987, a group of researchers analyzed all the SEC accounting, auditing, enforcement releases and just gathered statistics on those companies. And what they find is the average fraud lasts about 2 years. The most likely avenue for committing financial statement fraud is through revenue recognition. In Chapter 12, we'll talk about revenue recognition. And then the overstatement of assets, like inventory, is also a common method to commit financial statement fraud, and the understatement of expenses. And it's usually a combination of all these that companies do, because they're trying to increase their net income. And the average magnitude of the fraud was 25 million. But again, the standard deviation on the size of the fraud is enormous, because there's some Enrons and some WorldComs, but then there's also a lot of small companies that are not very big that are committing financial statement fraud in the order of like 1 or 2 million, not in the billions of dollars like WorldCom WorldCom and Enron. And in 72% of the cases, the CEO perpetrated the fraud, was the one who instigated the fraud. I think it's probably higher than that. It's probably closer to 100%. But you can't always prove that the CEO is involved because the CEO is not the one who's in charge of financial reporting, it's the CFO. So the CFO is almost always the one who gets in trouble, but usually you can implicate the CEO, but not always. So the average assets for these companies that committed fraud from 87 to 97 was 530 million. So again, that's not that big, especially compared to the Enrons and the WorldComs and the HealthSouths. But that's because there's a lot of smaller frauds mixed in. There were severe consequences. Usually, oftentimes the company goes bankrupt or stops trading. The management, usually, if there's not a criminal conviction, they're barred from running a publicly traded company in the future. So it ruins a lot of market value. Investors lose a lot of money. It also ruins a lot of careers when people get involved in this. And most of the frauds, these are the frauds that occurred between 87 and 97 had no audit committee. Now the Sarbanes-Oxley made it so that companies have to have an audit committee. And so now the audit committee meets on a regular basis and every company is required to have an audit committee. But in the past, that wasn't always the case. And this is where it also gets a little bit tricky because the board of directors for these companies that were committed fraud were more likely to be dominated by insiders or gray directors. And an insider on the board is an employee of the company. So, and that's pretty common. In fact, you have companies like Facebook where Mark Zuckerberg is the founder of the company. He's the major shareholder of the company, and consequently, he's the chairman of the board. So he serves two roles. He's chairman of the board of directors, and he's an employee of the company as the CEO. So in that case, that's not illegal. There's not necessarily anything wrong with that because oftentimes the founder is the one who knows the industry the best. They're in the best position to run the company, and being a major shareholder, they have the largest interest in seeing that the companies run well. So they're also appoint themselves chairman of the board because they're such big shareholders, nobody can outvote them. So they appoint themselves chairman of the board. And like I said, there's not anything like inherently wrong with that, but the problem is when there's a lot of employees on the board, then there's one less level of oversight. So there's nobody overseeing the CEO if the CEO is also chairman of the board. But if you have that separate where the chairman of the board is elected by the shareholders and then they're the one who hires the CEO, and there's another layer of oversight, it makes fraud less likely. And gray directors are like retired employees of the company, people who have been associated with the company but may not be currently associated with the company. And not surprisingly, companies that were able to commit fraud had employees that were also on the board. So the people that were committing the fraud were also on the board of directors, overseeing the people who were also committing the fraud. So there was less oversight in those companies. And some companies, a lot of these companies in the 87 to 97 were experiencing net loss or close to break even. So that put a lot of pressure on them to really show better earnings than what they should have actually reported, which is a loss or a break even. And then just over 25% of the companies changed auditors during the fraud period. And that's also pretty common because the more entrenched your auditor becomes, the better they know your financial position and understand your company and know the weaknesses of internal controls, the more likely they're to detect a fraud. So as they get close to the fraud and start asking difficult questions, then the company switches the auditor. Right? And then a new auditor comes in, and it usually takes a year or two before they really get up to speed and sort of know where all the skeletons are in the closets. So to be able to detect financial statement fraud, you really have to think strategically. And Mark Zimmelman, one of the textbook authors, he had written articles about thinking strategically when you actually suspect fraud, because when you go into a company, the best way to detect fraud is to first think, okay, if the company were committing fraud, how would they be doing it? Right? Because if you're a bank, you're going to be doing it differently than if you're a manufacturer, right? And if you're a manufacturer, you're going to be doing it differently than if you're an insurance company. So the best way to think is, okay, what's the most common type of fraud in this industry? Like, what are the accounts that are big enough that they could actually perpetrate a fraud in those accounts and they wouldn't be noticed, right? What are the accounts that have significant estimates where you could potentially do some manipulations and commit a fraud. So once you think strategically about, okay, where could the fraud occur, then you have to think, okay, if fraud is occurring, management's obviously going to try and hide it. So if they're going to try and hide it, then what are the red flags that I'm going to see? Right? So the questions to ask under strategic reasoning is, what types of fraud scheme is management likely to use to commit fraud at this particular company? And if they're going to commit fraud in revenue, for example, what are the typical tests that I could use to detect that fraud? Right? And knowing that management's going to try and hide it, they're going to try and conceal it somehow. So maybe I have to be strategic in how I do my testing. So if I think that they're going to commit inventory fraud and overstate their ending inventory, then maybe I need to do surprise inventory counts, right, and be less predictable in what my audit procedures are. And so being less predictable allows management a more difficult time concealing the fraud, because they're trying to, as part of their concealment, they're trying to guess what their auditors are going to do and the test that they're going to perform. And the more unpredictable that you can be, the more likely that you're going to catch them in their fraud scheme. So the other way to detect fraud is that you have to analyze the financial statements, and that's part of FS1, is doing an analysis of the financial statements and looking for unusual trends and relationships among accounts and across time. And one vital way to do that is use non-financial performance measures. And I'm going to spend a whole lecture talking about this, because this portion of the book was actually, with Mark Zimmelman and I were co-authors on a paper where we looked at non-financial information and how you could use that to detect fraud. So, for example, in the Health South trial, a prosecutor in the trial pointed out to a defense witness that the company's revenues and assets were increasing during the years of the fraud, but the actual number of Health South facilities, remember they're a medical facility, was decreasing. So they had fewer facilities, but they were reporting more revenue and more assets, which seems a little bit inconsistent, right? So comparing non-financial information to financial information is often one way to detect fraud. For example, another company that committed revenue fraud that materially overstated their revenue was Green Mountain Coffee. And if you look at Green Mountain Coffee, they were reporting the revenue was going up about 60% per year, but the pounds of coffee that they were reportedly producing was going up about 20% a year. So they were saying that we're reporting a 20% increase in the pounds of coffee that we actually produced this year, but then they would simultaneously report a 60% growth rate in revenue. So that seems a little bit suspicious, right? There may be that the increase in revenue is related to increases in prices for their products, for their coffee, but that didn't bear out. And some short sellers like David Einhorn noticed that. Well, David Einhorn, who runs a hedge fund called Greenlight Capital, noticed that and said, hey, they started shorting the stock because they thought that the company was overstating their revenue, which indeed they were. And the SEC conducted an investigation and found out that they did overstate their revenue, and they had to restate their revenue and ultimately their earnings. So using non-financial information that companies tell you about them can help you detect whether they're committing financial statement fraud. And not a lot of investors or auditors do that. Like I said, we'll spend a lecture talking about that. So the other thing that you want to do to look for red flags for potential financial statement fraud is look at these four things, right? Management directors, the relationship they have with others, the organization, the industry itself, and then what are the financial results and operating characteristics of the company. So looking at management and directors. First, you want to look at management background, because you're going to find that a lot of companies, oddly enough, well, maybe not oddly enough, but you find that management that's committing financial statement fraud has oftentimes done it in the past. Even with Enron. Enron's big fraud that happened in 2000 was not the first time that Enron had actually committed financial statement fraud. It had happened in the past with the same management team. So, and there's Sunbeam, the appliance maker. They hired a guy named Al Dunlap to come in, and he had a nickname of being Chainsaw Al Dunlap, and he could turn companies around by cutting their expenses and other things. So Sunbeam they felt like they're on a bad course. They needed somebody to come in, shake them up, turn the company around, and get them on the right path. They hired Al Dunlap, and but they didn't ever conduct a thorough enough background investigation because he had been involved with committing financial statement fraud with other companies in the past. So it's really important that you do a background check on management, not just when you hire management, not just for the board of directors when they hire management, but also for a new auditor. When an auditor comes in, you don't want to take a new job, bring on a new client unless you thoroughly vet that client's background and look at have management been involved in any shady dealings in the past. And then you also want to consider what's management's motivation. So maybe the background check comes up clean, but you realize that management does indeed have a lot of stock options and equity in the company, and their personal wealth's tied into how well the company performs in their financial statements. So the personal wealth is going to be tied into what they report as their earnings per share. And so looking at potential management's motives and incentives to commit fraud is helpful. It's not necessarily a red flag if they have a lot of equity in the company, but it's something to consider that if things do go poorly, they have incentive to commit fraud. Now and management almost always has the opportunity to commit financial statement fraud because they're the ones that prepare the financial statements. So all they need is be able to rationalize it at that point. So high incentive, high motive, all they need to do is rationalize fraud, and then fraud becomes more likely. And then management's influence in making decisions for the organization. So if you have a couple of managers, like the CEO and the CFO, making all financial accounting decisions, and it's concentrated in a small group of people, then fraud's more likely. Because if these 2 or 3 individuals who are solely in charge of financial reporting have incentive to commit financial statement fraud, and they're able to rationalize it, then fraud becomes more likely. The fewer people that are involved makes it more likely. But if a lot of people across the organization are involved in making financial reporting decisions and decisions related to accounting, then to commit fraud, you'd have to get a lot more people involved, and that makes fraud extremely less likely. So, like we mentioned, we also want to consider the relationships that the company has with others, particularly their external auditors. Because like we talked about before, if the company is going to potentially commit financial statement fraud and they worry that their auditors are catching on to them, they're going to switch auditors. And auditor switching is rare. I mean, companies like to establish long-term relationships with their auditor. It sends a bad signal to the market when you switch auditors, because switching auditors implies there's some type of disagreement between the client and the auditor. And when you do switch an auditor, you have to file a form with the SEC, a special form called Form 8K, and you have to explain to the SEC why you're switching the auditor. And the auditor actually has to sign off on that 8K, explaining that they agree with the company's explanations for why they're switching. And so it's generally considered to be a bad thing when a company switches auditors. Although, there's legitimate reasons. Sometimes management turns over, and management and the board have a better relationship with one audit firm versus another, so they'll switch audit firms. So sometimes it can be explained away. But in general, investors, regulators don't like to see a lot of auditor switches. And so that relationship, and if they have a contentious relationship with their auditor, and so maybe they do switch and they have a new auditor, and the reason for their switching was there was disagreement about accounting policies or something else, that's obviously makes fraud more likely, because maybe the auditor didn't like what the company was doing and the company wanted to find a new auditor, right? So anytime there's any type of unusual relationship or auditor switching sort of out of the blue, that creates a potential red flag for fraud. You want to consider their relationship with their lawyers as well. Do they have lawsuits, a lot of lawsuits that are pending, right? Are lawyers constantly having to defend them? Maybe the IRS is coming after them, so that also involves regulators a little further down the slide. Or maybe shareholders are suing them for whatever reason. So if there's a lot of lawsuits and they have a lot of different law firms working for them, that might be a little bit suspicious. And you also want to consider the relationship that they have with investors, because sometimes there's sort of famous investors that are out there that run hedge funds and other things, and they can tend to be activists. And they get on the conference calls with management when they report the earnings. They ask a lot of difficult questions because they're major shareholders in the company. And if they develop contentious relationships with investors, that's also a bad sign. And then if they see relationships with investors where they start short selling. So you'll see famous hedge funds or famous professional investors start shorting a stock. That might make you nervous because short sellers, sometimes more so than auditors, are the ones that detect fraud. And that was the case with Enron. A famous short seller named Chanos was the one who originally started looking into Enron's financial statements and started thinking that they were committing financial statement fraud. Like obviously wasn't Anderson. And these short sellers, they're pretty good about listening to management. They read the financial statements. They look for unusual trends and fluctuations. And if they see that the company's maybe doing something shady, like in the case of Green Mountain Coffee, David Einhorn noticed that they were producing, only 20% increase in coffee production, but a 60% increase in revenue. That made him suspicious. So he started asking questions. He couldn't get answers that he felt like sufficiently explained that gap, and started shorting the stock. And short sellers are pretty good at that. And short selling, if you don't know what that is, we make money by in the stock market by buying low and selling high. So when you go long, that means you buy the stock at a low price, and then you hold on to it, and then when the stock price goes up, you sell it at a higher price. But if you think a stock price is going to go down, the way you can make money on that is you go to your broker, and because what you need to do is you want to sell when it's high, which is now, and then buy later on. So to be able to sell first before you buy is you get your broker to loan you the stock, because the broker will take the stock certificates from another investor, loan them to the short seller. The short seller sells the stock, and then the stock price goes down. They buy the stock back, and then the broker gives it back to the original client. And so selling short's extremely risky though, and because if you invest $100 in Enron stock, the most you can lose is $100. But if you short sell Enron stock at $100, the stock could go up to $200. It could go up to $400. There's no cap on your loss because you eventually have to buy it back. And if you sell the stock first at $100, knowing that you have to buy it back in the future, if the stock price goes up to $400, well, and the broker makes you return that stock certificate, then you got to buy it at $400, and you've lost $300. So the potential loss on a short is unlimited because the stock can just keep going up. And you can be right about a stock that eventually it does crater, and that's what happened during the technology bubble. A lot of companies thought technology companies were overvalued, and they tried to short the stock, but the bubble kept going on longer than they anticipated, and the stock price kept going up and up and up. And your broker won't usually let you hold on to a short position for very long if the stock price just continues to go up, because essentially they're loaning you more and more money. And so they'll do a margin call and force you to buy the stock and return it to the original shareholder. So short selling is extremely risky, but if investors see a lot of if you see that investors are doing a lot of short selling on a company's stock, that might be a concern to you or a red flag that maybe there's some suspicious accounting going on in the financial statements, and professional investors are picking that up. Right? If they have unusual relationships with their regulators, so maybe it's the IRS. So if they're committing financial statement fraud, they might also be aggressively reporting their taxes, and so the IRS is coming after them. I mean, it could be simple things like maybe the EPA, Environmental Protection Agency, is coming after them because they're manufacturing, they're polluting the environment too heavily, they're not following regulations. And so if they have contentious relationships with regulators, it's not unlikely that they're going to have contentious relationships with the SEC related to their financial reporting. Financial institutions, if they have relationships with banks that seem to be suspicious, so they're doing dealings with banks in the Cayman Islands, they're doing banks in unusual locations, so maybe they're headquartered in Georgia, but they're doing business with banks in Alaska. And I say that's a little bit suspicious. And so anytime there's some unusual relationship that doesn't follow the normal course of business, they may be trying to hide something. And the same thing with bondholders. Maybe they have contentious relationship with their bondholders, just like their investors, and that might lead to their debtors being concerned that they're doing something suspicious. So the organization and the industry. Well, some industries are just riskier than others. software industry, sometimes for a lot of reasons, is prone to financial statement fraud. Um, and so some companies, or some industries, and it oftentimes has to do with their accounting, because their accounting is complex. And with software, that's certainly the case. Revenue recognition for software is probably the most complex standard that there is out there. And so anytime there's added complexity to an organization, especially related to their accounting standards, it creates an opportunity for the company to commit fraud. And we talked about earlier, if the board of directors has few outsiders, so they're mostly insiders, or they're mostly employees of the company that are on the board, then there's one less level of oversight that makes fraud more likely. If they don't have a good internal audit department, maybe they're a small company, and they don't have an internal audit department that is not following up and making sure that internal controls are adequate or in place, then fraud becomes more likely, a greater opportunity to commit fraud. We've talked about if they have offshore affiliates with no apparent business purposes. So if they're constantly doing business with special purpose entities, for example, in the Cayman Islands, that don't appear to be part of their business model. So like with Enron, they've got these special purpose entities that don't have anything to do with the selling of natural gas. That makes you a little bit suspicious that why are they doing things that are outside their normal course of business, and is that potentially a scheme to commit financial statement fraud? And when competition's high, that just whenever anything that puts stress on the company leads to a higher likelihood of fraud. And so when your margins are declining, so that because of fierce competition, there's less profitability, then that creates a tremendous amount of pressure on you to report earnings that maybe are unrealistic, and ultimately cause you to commit fraud. So a lot of these things are red flags related to fraud. And then financial results and operations. So you have to ask these types of questions. Are there unrealistic changes in account balances? So for example, if you're going to commit revenue fraud, then you fraudulently overstate your revenue. So you overstate the credit to revenue. Then you also have to overstate the debit. Well, you're not going to overstate cash, because cash is easy to audit. So you might overstate accounts receivable. So if you see revenue maybe goes up 20%, but accounts receivable goes up 200%, that might be a red flag that cause you to think, well, maybe that's a little bit suspicious. Maybe that accounts receivable is not real, right? And accounts receivable, for example, represents only the portion of revenue that's uncollected. So the fraud is going to be in the revenue account and in accounts receivable, but it's going to be a much bigger chunk of accounts receivable. So you might look for financial statement fraud on the income statement by scrutinizing the balance sheet more closely. So the other one is, our account balance is realistic given the nature, age, and size of the company. Right? Maybe they have unusually high accounts receivable for how small the company is. So why are their customers not paying them? Maybe the revenue is not real. Do the actual physical assets exist in the amounts and values indicated on the financial statement? In the past, a long time ago, like during the 20s, when companies weren't really required to be audited, if they did get an audit, there was no requirement that the auditors count inventory, and all the auditors did was just look at the books to make sure that they're following GAAP. They didn't really consider, well, what if they're committing inventory fraud? Well, there was a famous case where there was an oil, a cooking oil company, and they said they had a huge amount of inventory on hand. But if you actually just calculated how much inventory that was more inventory than existed, and that existed for cooking oil in the whole world. Like nobody in the world, if you put all the cooking oil together, didn't amount to the amount of inventory that they said that they had. So if they have an unusual amount of inventory, and you just think, well, I don't think that amount of inventory could even fit in their warehouse, then obviously things like that might be indications of fraud. And then, have there been significant changes in the nature of the organization's revenue or expenses? So a famous fraud a while back was by a guy named Barry Minkow. And he's another one of those that committed fraud, committed it once, went to jail, started a firm to actually detect financial statement fraud, then started another company and committed fraud again. So, Barry's committed fraud several times. But his first, when he was a young man, like in his like when he was like 19, he started a company that sold vacuum cleaners called ZZZ Best, and his vacuum cleaner sales company took off. But then he wanted to show even higher growth than what he was doing, than he could do selling vacuums. So then he switched to a building restoration service. So even though he was primarily, he said, a vacuum selling company, over time, most of his business came from building restorations. And his building restoration business was completely fraudulent. It was just a way to make his vacuum cleaner company to grow at a pace that he wanted it to grow at. And to fool auditors related to his building restoration business, when auditors would say, hey, I want to go look at this building that you're restoring, he'd be like, yeah, come by on the weekend. And he would just hang sheets and stuff outside of a building that he had no relationship to, just to make it look like they were restoring some building. So he was in the process of fooling his auditors as well. So anytime you see these types of unusual relationships, there's potential for fraud. And this is just an overview of fraud. And next chapter 12, we're going to talk specifically about revenue and inventory frauds and provide details as we go forward about the types of fraud and how it happens, how they manipulate the financial statements.